Welcome to the past examination questions go through regarding the quality control. The first questions that we'll be looking at is called Rockwell and Co. And as always, you are given the requirement of 4 marks, and it's a discursive type of question, which means to discuss the quality control procedures should be carried out by Rockwell and Co. before the audit report being issued. 4 marks here. Now, so in this case, we are not required to comment on the general quality control procedures, because quality control procedures can be applied to the firm as a whole and to the individual engagement. But here we are talking about before the audit report issued to the Hopper Group. So Hopper Group is our audit client. So we are talking specifically about the quality control for the engagement letter, which means the individual engagement, individual contract related to a client. Now, you are an audit manager, a firm of chartered certified accountants. Responsible for the audit of a listed audit client is called Hopper Group, which supplies ingredients to the food and beverage industry worldwide. Okay, so for example, providing some flour, sugar, I don't know, all kinds of stuff like that. The audit work is nearly complete and you are reviewing the draft audit report prepared by the audit senior. So the question is, why are you going to review the draft audit report? First of all, this is a must, this is a requirement in the ISA. And second, you would like to improve your audit quality or to maintain your audit quality. Let's see the exhibit then. The audit findings. So in other words, we find out something may have gone wrong during our audit. So during the audit, we found out that in management's calculation of goodwill, the directors failed to recognize consideration contingent upon meeting certain development target, i.e. the violation of IFRS 3 business compilation. So in other words, when we calculate goodwill, we need to use the fair value of consideration. So in other words, it's the cost to the buyer, how much does the buyer need to pay. So in terms of fair value, so in other words here is the contingent consideration. So what do I mean by contingent consideration? Is that what I can pay as a buyer, from a buyer's point of view, I can pay a certain amount of money to acquire your shares because I acquired your shares, but I will pay for that at some point in the future depending on whether or not you can meet with my target. So for example, we set a target as, let's say, to increase the sales revenue after you have been acquired by my company. The revenue should have been increased by 30%. If the target is met, I would pay additional, let's say, $5 million. I'm going to plot the NCI, non-controlling interest, and to minus the fair value of equity of your company. So the excess amount will certainly be the goodwill to be recognized onto the consolidated statement of financial position as a non-current asset. But here, it seems that the contingent consideration here was not calculated correctly. And that's why we're going to be discussing the quality control procedures to be applied. So in the discursive type of question, I would say to the examiner, I'm going to be using the 2-steps approach. So first of all, giving your points and to expand your points a little bit further. So you can relate your point back to the standard requirements, or you can talk about why this will be important and the implications of that, and so on and so forth. So given 4 marks here, so if I were you, I would like to write 3 points related to this requirement. The first point I would like to write, because it's a quality control, of course, review part, that's important. And that's why we need to appoint the quality control reviewer. That's important there. And of course, you can expand your point a bit further. I mean, if you're very familiar with the ISQC number 1, and of course this is per the International Standards on Quality Control number 1. Alternatively, you can say that you don't really need to quote the ISQC number 1 in your answer, but you can say appointing the quality control reviewer will certainly improve the quality control by spotting potential mistakes made by the auditor. Okay, and of course you can also talk about, I mean, when selecting the reviewer, the requirements. Okay, from our tuition course, the requirement of being a reviewer should be a senior personnel or senior partner. But I can also talk about the engagement partner, and here, specific to the case, cannot appoint the reviewer for this engagement. So in other words, if I'm responsible for signing the audit for a Hopper group, I cannot appoint the reviewer for the Hopper group. Okay, it's audit. That's very important there. So you can talk about lots of things related to reviewer in your answer, but make sure you don't really just come up with your point. We're going to appoint the quality control reviewer and full stop. There'll be no marks for that, perhaps. Maximum of 0.5, but normally no marks for this because you're not discussing it. Therefore, you can expand your point a little bit further like this. Okay, make sure that you are absolutely happy with the standards that we've talked you through in the tuition course, and that's very important there. The second part is where we're going to be talking about the discussion part. Okay, so in other words, the communication as to my first point is very, very important there because there might be opinion differences, okay? Arises between the engagement partner, which means the partner responsible for the Hopper group, and the quality control reviewer. And therefore, per the ISQC number 1 requirement, the opinion differences needs to be resolved by the engagement partner. So you can also talk about that in your exam. Regarding the contingent consideration treatment, of course, is the engagement partner. To resolve this issue. Okay, so in other words, it's up to the engagement partner to decide who is right. And of course, for the quality control reviewer, what they need to do is the QC reviewer to review, first of all, the financial statements, and second, the audit report. The reason why this is the case is because it needs to see whether the opinion is correct. Okay. That's very important there, because the quality control is not maintained. The implication for that, you can say in your answer, that the client may have professional liability. So, the auditor or audit firm may bear professional liability as a result of it. So, for example, if the opinion is not correct, may be sued by the client. So, only for that, what reviewers should do is to review documentations. Okay, that's very, 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 very important there. So, it's to review the evidence documented by the auditor. And here you can talk about lots of reviews for that. So, for example, making sure that the hot review is done correctly, and also the second partner review is done correctly. So, hot review, in other words, the audit senior is responsible for reviewing the files compiled by the audit junior, perhaps on a daily basis. And the audit manager is required to review the audit files compiled by the audit senior, perhaps on a weekly basis. So these are the hot reviews. And second partner review, so in other words, we need to have a second partner to review the work done by this particular audit team. And then we perform the quality control review and to review all these procedures have been applied correctly in our firm. Okay, so that's the number one. And of course, we need to think about the audit report implications. So in other words, if I decide from the quality control reviewer's point of view, if I were to decide that the financial statements need to be qualified in my audit report, and I would communicate this, of course, with the engagement partner, and the engagement partner needs to communicate this with those charged with governance. So the partner, the engagement partner, needs to consider, for example, number one, communicates with the audit committee, which means those charged with governance in the client's company. Second, the nature and extent of the modification of audit report. Either one or two can be applied in your answer. And here applies number two. So for example, consider whether a qualified or adverse opinion is required. So either qualified or adverse opinion for this particular event, the nature of that will be the misstatement, which means the violation of IFRS, because it does not follow the IFRS number 3 business combination there. And of course, next one is to communicate this with those charged with governance. That's another point. And also, the audit report must not be inside until the completion of the quality control review. And that's the points that we brought to you in our tuition course. Okay, so make sure that you've done with the quality control review, and then you're going to sign the audit report. Okay, so this is per the ISQC requirement there. That's very important there. So I'm going to bring 3 points, 3 to 4 points, but most likely I would like to write 3 points in my answer and to get these 4 marks. Okay, not particularly difficult because I've given you 1, 2, 3, 4, 5, 6, 7 points, so you can pick up 3 of them. You can talk about what quality control reviewer actually does and fulfill your content, fulfill details in that. You can get very high marks in this particular question. Now, let's look at another question. Is for the kennel and co. Okay. Again, we are going to be seeing the requirement first of all, and in relation to audits, to evaluate the quality control, ethical and other professional issues arising in respect of planning and performance of a group audit. So in other words, from planning to testing and to review, we need to comment on, so I can't use the word comment, but I need to evaluate the quality control implications and so on. So in other words, if I were to see this verb, evaluate, I'm going to apply the 4 steps approach here. That's very important there. There are 13 marks here. So are you going to write 13 points? No. So possibly you're going to be writing 6 points, up to 7 points. But most likely, I will not write too many points in this particular examination, but I have to ensure that each point I've made will be very high quality, and that's why 6 points will be my target. I will target 12 marks out of 13 in this particular requirement. So think about it in this way. If you have written 6 points, and for each point, you should have got 2 marks, but actually you've got 1.5. So if you've got 1.5, we use 6 points times our 1.5, you can get 9 marks. 9 marks out of 13, that would be passing this question. Now that would be congratulations, and that's very perfect. Okay, so therefore, I would like to aim to write 6 points here. So let's see the case background first of all. Is the Kennel & Co. is a firm of chartered certified accountants, external audit provider for the group. The group is called Retriever Group, and the manufacturer of mobile phones and laptop computers. The group obtained a stock exchange listing in July 2012, and the audit of the consolidated account for the year ended 28 February is nearing completion. So it seems that you've obtained a listing up to the year end is less than 1 year. Okay. You are a manager in the audit department of Kennel & Co., responsible for conducting engagement quality control reviews on listed audit client. Okay, so you're not responsible mainly for the audit of the Retriever Group, okay, because you can't be the engagement partner for this Retriever Group and to review the quality control stuff. You've discussed the group audit with some of the junior members of the audit team, one of whom made the following comment in the exhibits number 1. So let's see the comments made by the audit team in the exhibits number 1. So it says, the audit has been quite time pressured. So in other words, if the audit is under time pressured, it's very important that you consider that the quality would not be lowered. So in other words, the quality cannot be sacrificed. So you cannot simply, due to this reason, to reduce the work, extend, and so on to complete the audit. You need to allocate appropriate resources to your audit. The audit manager told the juniors not to perform some of the planned audit procedures. Okay, so we catch the audit manager. So the audit manager was certainly did the wrong thing. So for example, on items such as the director's emolument, so in other words, his director's remuneration is the payment to directors in terms of salaries, share options and so on. But this is high risky area that we need to check them very carefully. And also share capital, as they considered to be low risk, no, and these are very high risk areas and we need to check them very carefully. He also instructed us not to use the firm's statistical sampling method. Okay, so that's the second point. Statistical sampling method should be used unless this is not applied to this particular client. And that's why we use, for example, the block samplings to check all the items, or perhaps the haphazard sampling using a judgment. But here, statistical sampling, it seems that to this complaint is quite relevant. But in selecting trade receivable balances for testing, it will be quicker to pick the sample based on our judgment. No, you use the haphazard sampling method, but this is not allowed. This is not a correct reason for that. It's simply because if you were to use your judgments, in other words, haphazard sampling, you have to ensure that perhaps this really applies to this industry, but it's not due to the reason that you can do the work quicker. Okay, so that's the second point I can comment on in my answer. And then 2 of the juniors were given the task of auditing trade payables and going concern. So it seems that each paragraph was done for a particular point I can discuss. Juniors are not really allowed to audit the going concern because it seems that they don't have much experience in that field. Because in determining whether or not the client's completes the going concern, we need to apply a judgment. So in terms of whether or not the client's strategy is appropriate and whether or not client's future and also indicators, for example, the left of CEO, the left of finance director, also constitutes the reason for going concern. We need to understand the client's business activities. We need to understand its operations, its internal controls, its abilities to obtain finance from the bank, and so on. So this is quite a complicated task, but juniors are allowed to audit, for example, the trade payables by checking the supply statements reconciliations and to circularize for example, the potential customer when auditing the trade receivables. So juniors are allowed to perform very simple tasks in practice. For example, checking the trade payables, receivables, calculating depreciation balances, depreciation expenses, and so on. So these simple tasks can be delegated, but going concern will certainly be an area that audit juniors should not be doing. The audit manager asks us to review each other's work because it will be good training for us, and he didn't have time to review everything. Okay, so the audit manager should do the hot review, which will be another point. Because as I said before, it's important that the hot review, for example, to be performed on a daily basis or a weekly basis, that should be done, or monthly basis should be done. So for example, audit junior's work should be reviewed by the audit senior, and audit senior's work should be reviewed by the audit manager, and this is a requirement. So you cannot simply say it would be good for you, for audit juniors, to review each other's work because it's good for training, and you can't say that. You are violating the requirements in the ACCA, or in other words, it's and also ISO as well. Okay, that's a very important point that you can comment on. I was discussing the group's tax position with the finance controller when she said she was struggling to calculate the deferred tax asset that could be recognized, and the deferred tax asset arising because several group subsidiaries have been loss-making this year, creating unutilized tax losses. Okay, so deferred tax asset, in other words, according to the IAS number 12, International Accounting Standards number 12, income taxes. Yes, we've got deferred tax asset. In our previous sections that we've talked about the deferred tax asset, for example, quite a lot of public listed companies may acquire other entities who are loss-making, so to enjoy the tax benefits. In other words, in a group financial statements, we could recognize the deferred tax asset to reduce the income tax expenses and to increase our profit in the current year when we buy the target company shares if the target companies are loss-making. And this is why this is in practice, in an actual audit, the deferred tax asset, we need to see its recoverability. So whether or not the entity will have future sufficient trading profit to offset against the tax losses that we previously bared, and so we're going to utilize, or we're going to offset the tax losses with the trading profit to reduce our taxable profit. And the extent that we can recognize the deferred tax asset, that need to be reviewed very carefully, because that would be a very high risky area, okay, for this particular company. And as I just studied deferred tax asset at college, I did the calculation of deferred tax asset for her. So in other words, from the ethical point of view, and that would certainly be a self-review threat to objectivity. The reason why this is the case is because I did the calculation, I checked my own work. So this is absolutely not allowed. The audit manager said this save time. Again, saving time is not a very good reason for that, as we now would not have to audit the deferred tax figure. Okay, so in other words, you are not only creating a self-review threats to objectivity, you're breaking the quality control procedures. So it's not up to the standard, in other words. Finally, the finance controller also asked my advice as to how tax losses can be utilized by the company. I provided her with some tax planning recommendations, which she was very grateful. So in other words, okay, I provided her with some tax planning, certainly be a self-review threats to objectivity. So for example, I would provide her with an advice to acquire more PP&E. More PP&E will constitute more depreciation expenses to be recognized at some point in the future, and then I check it on my own. So I check the depreciation expenses later on. I will certainly be constituting the self-review threats to objectivity. It's simply because I provided her with the advice, I designed this for her, and then I check it on my own. Now, how many points I'm going to write them? So according to the exhibits, 1, 2, 3, 4, 5 and 6, okay, 6 points, that would be sufficient for you applying the 4 steps into gaining these 13 or perhaps 12 marks. So that's very important because the last mark evaluation would be your conclusion, for example. The 4 steps I'm going to be using for evaluating the quality control. First of all, I'm going to say my point as the step number 1 is what, and per the standard, what should we do? And whether the standard is followed, I'm going to say why this is important or the implications if misstatement of mistakes have arisen and how we should improve that as a step number 4 then. And for the ethical question, on the other hand, we're going to be applying the 3 steps here. For example, stating, for example, the self-review threats to objectivity and whether per the Code of Ethics, so for example, this is not allowed per the ACCA Code of Ethics, and also providing my recommendations, a safeguard of how to improve the situation a bit further. Okay, that's all we can do. Now, the first point, as I said, in exhibit number 1, is the time pressure that I can comment on. The time pressure. So the first point I'd like to write is, first of all, is the time is under pressure. So, per the standard, what we should do is that we should maintain quality during this process. And the reason why this is the case is because to reduce the risk of giving wrong opinion. As a step number 4, how we should improve that, we could say we can extend the deadline a bit further and to discuss with the client. Another ways that we can do will be to allocate more resources to this particular engagement, and as a result, we'll charge more audit fees as a result. Okay, so these are the 2 ways that you can do as a step number 4 there. Okay, second is the director's remuneration. In other words, it's director's emolument. So it's the payment to the director. So according to the IAS number 24, related party disclosures, and this will be an example of related party. And therefore, first point, I will say that this is the related party transaction. And second, per the standard, of course, these are the high risky areas that we need to check very carefully. And the reason why this is the case is because we need to ensure that they are disclosed properly per the IAS number 24. If you can't remember this, you can substitute this with the IFRS International Financial Reporting Standards instead of saying International Accounting Standards number 24 related party disclosures. And therefore, you should audit in more detail, okay, of such areas. That's important there. So that's the second one, is the related party. Okay, that's the second one, is the director's emolument. And yeah, let me talk about the second star here. Another star would be the sampling method. Okay, we can talk about statistical sampling method. So, first of all, we've talked about the sampling method not using statistical. So in other words, it's not using the random testing approach. That's not allowed, of course. We can talk about that. This is the first point, this is what. And the second is not per the ISA on sampling. So in other words, is not acting per the international standards on auditing on sampling standard, and not allowed. Okay, so make a comment on that. The reason why this is the case is because you need to ensure the sample is representative of the population. Okay, that's my step number 3. I'll just underline this as important there. And how you should improve that, of course, we will review the sample appropriateness by the junior. Very carefully to identify any potential errors as a result of it. Okay, so that's how we comment on the sampling method. We can't simply say to the examiner, okay, the client is using haphazard sampling and this is not allowed. So if you're saying that, that would be 0.5 marks in your exam. So even though you've made several points, so you can see in your actual scripts, the marks are so low, and that's the reason behind it. Another area would be the going concern. Okay, so to delegate the going concern work checking to the audit junior. And I would say that this is the high risk area. And second, per the standards, I mean, there'll be no actual standard in saying that the work should not be delegated, but I would say that it will be implying a lot of judgments to be applied in determining whether or not the client's company is going concern status. And the purpose of that is to ensure that the more complicated areas will be assigned to the senior staff. So to senior staff for complicated areas. And number 4 then, how we should improve this. And here I said that for going concern, we should check the client's forecasts about the profit. Check future profit of a client's company. And to confirm if they meet with the market situations. Another thing I can talk about is to see its abilities to obtain finance, to secure finance, okay, to support its going concern status. That's important now. And another point is to review each other's work, okay. And of course, not doing the HOTS review, this is not appropriate. So, first point, no HOTS review by the manager. Second point, this is not appropriate. The reason why this is important is because we need to find out mistakes in the working papers. So HOTS review, that's very important because we can timely find out the mistakes made by the more junior staff. So for example, junior's work reviewed by the senior, senior's work reviewed by the manager, manager's work reviewed by the partner. So HOTS review should be done on a frequent basis to find out mistakes on time. So therefore, the recommendations for that is the manager should do the HOTS review or should perform the HOTS review. Okay, so that's the review of work. That's important now. So how about for deferred taxes? Okay, and the next point I would say, next point, the next start, in other words, I did the calculation for her and don't need to check them. Okay, so deferred taxes. So first of all, I can say that they are unable to calculate deferred taxes, and we are questioning her competence as a result. And I would need to increase my professional skepticism in checking other areas of their work in terms of accounting to see whether or not that would contain material misstatements as a result. So the effect of that would be the control weakness on other areas. And what we need to do, maybe to communicate this with those charged with governance. Because as I said, they are not competent in doing the work correctly, and that would certainly be not only a mere, which means the small deficiency in the internal control system, but also the significant control deficiencies. And therefore, that needs to be brought to the attention to those charged with governance. So in other words, we need to communicate that with the audit committee. And of course, I would say that the ethics part is the audit junior did the calculation for her, giving rise to self-review threats, and depending on the materiality of the balance, and of course, if the currency is listed and the balance is material, we need to confirm the materiality level, and we should delegate more resources, delegate more staff, more senior staff to review the work done by the junior. And of course, do not audit the deferred tax asset value at all. Of course, this is not appropriate. That's the step number 2. Involves high level of uncertainty because the recoverability of deferred tax asset, and the reason why we're going to do this is to ensure the ICE number 12 income taxes requirements are followed. And what we need to do is that the computation should be checked more carefully. And finally, the advice on tax losses, and the audit junior provide tax losses and appropriate, not appropriate at all. And this is non-audit work on a separate engagement, should be provided. If we provide this advice, we are deemed to take management responsibilities as a result, and also the self-review threats to objectivity. So the reason why this is important, because we need to ensure that we are objective in giving the audit opinion. So which confirmed whether or not recommendations being followed. So in other words, that will be the step number 1, that will be a step number 2, and that will be the step number 3, the reason, and that will be the step number 4. Okay, so if they follow the recommendations, of course, we need to check them very carefully. That's very practical. So if they are not following our recommendations, then that will be absolutely fine. We don't need to check them. Okay, but we need to check them if they follow the advice provided by the junior. Finally, you can make your conclusion to gain 1 mark. So as the final mark to this 13 marks question. So for example, you can say that you need to get all the team members to understand the purpose of audit work to ensure that their responsibilities are discharged or conducted, or they can bear their responsibilities in the correct manner. So you're going to train, for example, audit managers and train audit junior members to ensure that they know what can be done and what cannot be done. Of course, members cannot provide advice to client unless this is agreed in a separate engagement letter. So that's important now. Okay then, now let's look at another case. It's called Davis Company. Here, we are given many marks for this, 4, 6, 4 marks for each of the requirements. Now let's see the requirement first of all. We're going to evaluate the quality control issues. Okay, that's the first one. So again, we're going to be applying the 4 steps approach and the implications for the completion of the audit for any, including any further actions should be taken by the firm. Your answer should include the matters to be communicated to management and to those charged with governance in relation to audit. Okay, so in terms of the mere and significant deficiencies of internal controls that need to be brought to the attention to those charged with governance. Let's see the exhibits number 1. So we're seeing the case background first of all. The audit of Davis Company's financial statements nearing completion. An audit report is due to be signed next week. And Davis Company manufactures parts and components for the aviation industry. Conducting the engagement quality control review, so you are quite separate from the person who will be signing the audit report. And if identifies the issue relating to quality control, and in the exhibits number 1 now. So exhibits number 1, 4 marks here. So in other words, you don't need to write 4 points related to the exhibits number 1, so possibly you're going to divide your answer. For example, here is the exhibits number 1 is for trade payables, and then I'm going to use the subheading as number 1 on payables, and then quality control issues, implications for completion of audits, and further actions, okay, and matters to be communicated. So each of the headings that needs to be applied correctly now. Okay, you don't need to write many points, but as each of the requirements, sub-requirements, you need to write a full paragraph for that. Now, the planned audit procedure to trade payables was to place reliance on purchasing controls and keep substantive tests to a minimum. So, if your aim is to keep substantive tests to a minimum, you should confirm the control system of a client's company related to trade payables are very strong. So you can do that. During control testing on trade payables from a random statistical sample, that's fine. The audit team identified 3 purchase orders have not been authorized by the procurement manager. So, for example, from our previous studies, if we find out any particular the not authorizing the purchase order, which means the weakness in the internal controls, what we need to do is to extend the sample size. So after the original error and extending the sample size, we find out the subsequent errors, and we're going to total them up to calculate the projected deviation rate. If our projected deviation rate, or we can call it the PDR, is higher than our tolerable error, later on we will need to come up with the follow-up procedures. So we will need to communicate these with those charged with governance. Okay, so that's important now. On review of the supporting documentation, so in other words, it's a source document, the audit team concluded the items were legitimate business purchases and therefore concluded there are no additional procedures were required. So in other words, if a business buys anything, the business needs to spend the money out. If the business needs to spend the money out and it seems that if it is a fraudulent transaction, it's like stealing money from the company. But here it's for legitimate purchases, and that could be fine. Because those are legitimate, it seems that, so either will be due to the internal control weakness that constitutes the purchase order not being authorized, or perhaps it's just to be due to one-off human errors. So what we need to do, first of all, in our answer, we will talk about the quality control first of all. The step number 1, not authorized by the manager, and step number 2, according to the standard, so for example, proper controls, so for example, segregation of duties that need to be in place. And therefore, there might be an implication as to step number 3, perhaps some of the non-legitimate purchases we haven't sampled, we haven't checked, we don't know whether or not that goes wrong. So what we need to do as the step number 4 then is the improvement. We should communicate and to report to the manager and partner immediately with regards to the purchase order not being authorized. Next one is the implication for the audit. So what will be the impact on the audit, in other words. So what we need to do is to consider the internal control deficiencies. So for example, we can bring the ISO knowledge, for example, increase the original sampling size. In other words, we're going to extend the sample size. So this is to calculate the projected deviation rate and to see whether or not that's higher than a tolerable error. So that's the implications, that's important. If the projected deviation rate or PDR is higher than a tolerable error, we need to consider further actions. So for example, we should review whether a control-based approach is appropriate or consider more substantive testing to be done. So in other words, we're going to be checking more source document. So for the trade payables, it would be the purchase order. And then you receive the goods from the seller. So in other words, you need to check the goods received note and the invoices as well as the contract. So you need to check more stuff, more source document, rather than to see whether or not that's authorized and to identify more of the non-legitimate purchases from the business. That's important now. And of course, that's the further actions. So, for example, is to increase the testing, particularly for substantive testing. And of course, you will need to consider the matters to be reported to management of those charged with governance. So in other words, here is a significant deficiency in the internal control. And therefore, that needs to be communicated to those charged with governance, okay, to the board or perhaps to the audit committee, if a separate audit committee is set up in that particular kind of company. Okay, so that's number 1 then. Number 2, following a review of the petty cash transactions, the audit assistant identified the petty cash share paid for taxi fares for personal, non-business journeys with a total value of 175. Following discussions with the audit assistant, you have ascertained he did not report this matter further as the amount of immaterial, and the audit assistant also commented the petty cashier is his brother, and did not want to get him into trouble. Of course, absolutely this is not allowed. It seems that you're colluding with the client to commit the fraudulent transaction here. So again, we're going to divide these into separate headings. I'm going to talk about the quality controls, and here we combine this with those charged with governance communication as well as the final step, as the step number 4. And then I can talk about the ethics, because in the requirements it says you're going to evaluate not only for the quality control issues, completion of the audit, further actions, and communication with management and to those charged with governance. So 4 things that need to be included here. Implications for completion and further actions needed. That's important now. So as the step number 1 then, to comment on the quality control, it seems that this would be a fraudulent transaction. And per the standard, of course, according to the ISO 240, but you don't really have to quote this, although we have covered this in our tuition course previously. And here, from the auditor's point of view, although we've got secondary responsibilities, because the primary responsibility is for the management to identify these fraudulent transactions in the first place. But if we check the financial statements of a client's company, if we found out that the fraudulent transactions total value will be material to the account, but we haven't detected it at all, we will bear secondary responsibility for that. Although, in theory, we are responsible for obtaining reasonable assurance, which means lots of confidence, we are doing many works, the financial statements which are free from errors due to frauds and errors, but actually we are bearing the secondary responsibility as a result of it. And therefore, what we need to do is we're going to review the petty cash records and to discuss the matters with the management, because it seems that this would be a deficiency in the internal control. So we need to bring this matter to the management, in other words. From the ethics point of view, that would be a familiarity threat to objectivity, of course, because it seems that the auditor and his brother, as an accountant and so on, would be quite close. And we need to highlight this with the engagement quality control reviewer, but we failed to do that. Okay? So it seems that it's not integrated at all, so the auditor is not trustable at all, okay, from the ethics point of view. And we're going to quote what the standard says, or the implication, or the reason. So the auditor, primarily the audit engagement partner, has responsibilities to monitor ethical requirements throughout the audit process. As I said before, for the individual engagement letter, for the ethics part, will be one of the requirements in the quality control. How about for the implication for the completion of the audit then? Of course, the firm's procedures to assign staff to audit team members and for reporting personal relationships should be reviewed to see this particular responsibility. So we're going to find out whether or not there are similar cases related to it, because that will be one area that causing our attention to think that the integrity may have some problems. And that's why we need to check them very carefully to see whether or not there are other instances that the relationship may not be correct from the ethical point of view. That's for the completion of the audit implications. So the further actions to be carried out by the auditor is that if I were to conclude that the fraudulent transactions increases the overall assessment of fraud and control risk, we need to report to management and possibly with a recommendation in the management letter. Provide it to the management, because it's their primary responsibility to detect and to prevent the fraud and errors. And if the fraud and errors actually took place, of course, from the external auditor's point of view, if those have a material impact on the financial statements, we fail to check it, we fail to communicate these to those charged with governance and management, we will bear secondary responsibility. But further actions from a practical point of view, because we will be working with you, for example, for the next year's audit as well. So currently, we identify these particular weaknesses, and then I'll report this to the management and those charged with governance, and possibly with recommendations of how to solve it in the management letter as a bonus provided to those management and those charged with governance. And that could be the action taken by the audit firm. The further actions, of course, what you can do is to increase the testing, okay, on such areas. For example, increase the sample size and so on. You can say that in your exam. Okay, that's number 2. Number 3 then, another 6 marks, is that the cut-off testing on revenue has identified 2 goods dispatch notes dated 2nd December 2017 for items sent to Chinco with a combined sales value of $17,880 included in revenue for the year ended 30th November 2017. So what do I mean by cut-off is we look at the year end. For example, the year end is 30th November 2017. For any sort of items, we check the goods dispatch note. If the goods dispatch note signed by the customer dated after the year end, that should be the revenue after the year end. So a lot of businesses may try to send the invoice to customer before the year end, but asking or dispatching the goods to the customer after the year end. So a lot of businesses may try to recognize the revenue just before the year end. So in other words, based on the date that the invoice is raised and sent to the customer, but this is not correct. So what we should do is to look at when customers received the goods and signed the GDN or the goods dispatch note, and that's very important now, because it will be nonsense if you can recognize revenue but the customer haven't received the good at all. So that's important that you notice this. That's what I mean by cut-off. So cut-off is to cut the year end off and to not to recognize the revenue early in the current year if the revenue belongs to the next year's account. And the client's financial controller is called David, as explains to the client, does not order on a regular basis from the Davis company. And in the absence of regular payment with Chinco, therefore, and in order to minimize the receivables collection period, the sales invoice is raised and sent to a customer on the same day when the sales order is received. Okay, so this is not correct, of course, because the customer has not received the goods yet, and only a sales order is received, but you dispatch goods perhaps after the year end, and therefore you should recognize revenue after the year end. And there will be no point in saying that you would like to reduce your receivable days, and that's why you're going to recognize the revenue earlier in this year. There will be no point in doing that at all. The average time period between the receipt of an order and dispatching the goods is approximately 1 to 2 weeks, and the audit working papers concluded no further investigation is necessary. So the client thinks that it may be very quick to dispatch the goods to customer, and therefore we can recognize the next year's revenue into this year on an early basis, but that's not an appropriate excuse for doing that. And that's why in the number 3, first of all, we can evaluate the quality control issues. So for example, is a breach of the IFRS 15 revenue from contract with customers, because recognizing too early, because the customer have not obtained the goods at all, and therefore the receivables revenue and profit have been overstated. And I can say that using the total value is only 0.2% of the total revenue. If I were to divide by the group's revenue, total revenue of $8.7 million, that would be accounting for 0.2% for a single transaction worth of $17,880. is less than 0.5% of the revenue, in isolation for this area, it's not material to the financial statements, but there might be potential other areas that combine altogether, that altogether combined may be material to the account. And what will be the implications for the completion of the audit? So, for example, we should extrapolate the errors and to predict the other errors that's available and to constitute a material impact for that. So what we need to do is to extend the cut-off testing on the revenue part. And further actions, I would, if I were you, I would like to increase my professional skepticism. So in other words, we will review last year's cut-off procedures and all misstatement communicate to management. That's very important now. So the matters to be communicated, so for example, the accounting practices. So because they will view that the sales orders raised and recognized as the revenue and the accounting practice is not in following the IFRS number 15. And that would be communicated to those charged with governance per the ISA 260 as well, but you don't have to quote this ISA number. The final part. The finance director has not completed the tax computation for the year ended. He has recently asked the audit assistant to calculate the company's tax payable. This is not allowed, of course, because it constitutes a self-review threat to objectivity, on the basis that a recently qualified chartered certified accountant and the audit assistant was more up to date with the recent changes in tax legislation. Of course, for this non-audit assignment, that needs to be agreed in a separate engagement letter as a result. And when we are commenting on the quality control issues, first of all, the calculating of the income taxes is the self-review threats to objectivity that breaks the ethics part in the quality control. And it seems that the auditor should not prepare the tax computations for listed clients, of course, per the ISBA code or the ACCA code of ethics. And of course, because the client is a listed company, that will certainly increase that risk of not giving a correct opinion on the financial statement, and because of this threat to objectivity. So that's the step number one, and that's the step number two per the standard. And so step number three, the reasons or implications, is that we should not undertake tax services because it's so high. Okay, the risk is so high to the objectivity. Okay, to allow the audit firm to undertake the engagement to prepare calculations of current or deferred tax, for preparing accounting entries, material to a financial statement, together with the disclosure note, is so high risks, and that's why this is not really allowed. Okay. So what we should communicate to those charged with governance, of course, we should, including the previous matters, for example, the tax advice and our auditor's professional judgment, and are significant to the oversight of the financial reporting processes, or to affect their financial reporting or their financial statements quite a lot. And therefore, the lack of skill and up-to-date knowledge of the finance controller and finance director need to be reported to those charged with governance, and we should require the company to update the tax knowledge perhaps on this particular issue. The further action is we will also report the independence issue relating to the finance director's requests for the auditor to calculate the tax payable to those charged with governance, because those charged with governance, so for example, audit committee needs to work with the external auditor. And when working with the external auditor, we need to report our ethical status in terms of the independence issues. So that's very important now. Okay, so it seems that we are not very close to the client, for example, to the finance director, not on the family-based relationships and not holding shares and so on. We need to declare this to the audit committee is the further action. Okay. So quite a complicated and also very enjoyable and very interesting case that we need to consider for the quality control. I hope you're happy. I'm going to stop this recording now because we've covered quite a lot of things. I'm going to be stopping the recording now, and I look forward to seeing you in the next of our section, and happy studying. Bye for now.
APC